Market neutral options traders are used to a high win rate on the strategies that they trade. Typically, a market neutral options trader will trade the same strategy every month, month after month, and therefore gets 12 bites at the apple, so to speak. And a typical expectancy for these kinds of strategies is 8 to 11 winning months per year. Well, just for your information, that's a really high win rate. If you were to compare that to day traders or swing traders, they're used to losing half of the time or more than half of the time. Some of the greatest traders in the world lose more often than they win, but when they win, they usually win big. And that's why they're so successful. Well, this is a different kind of a discipline. This is a discipline where your average wins are a bit lower, but you're winning on a more consistent basis. So analyzing winning trades, it might feel good, but in fact, it's a lot less useful than analyzing a losing trade. Winning trades are kind of expected because of the nature of these strategies. If the market doesn't move, most likely you're going to make good money on one of your trades. So, but a losing trade is really something that can be learned from. So let's take a look at an example. Let's suppose that in March of this year, you entered into a May iron condor. An iron condor is basically a strategy where there's a short call way above the market and a short put way below the market. And you have some protection around those, but the essence of the trade is the short call and the short put. If the market closes between the strike of the short call and the short put, you get to keep the entire premium you received by placing that trade in the first place. That's a quick way of describing an iron condor. So if you had an iron condor strategy and your decision-making process was, there is, as you can see in this case, an 82% statistical probability of profit, then if your decision-making process was, I'm going to let the statistics just play out, and if the strategy makes money 82% of the time, there's a decent chance that the market will stay between those two strikes and I'll get to keep the whole credit. So if that was your strategy, not a strategy I'd recommend, by the way, but if that was your strategy, what's called a set it and forget it strategy, then you would put this trade on and watch it expire, basically about 2 months later. So as long as the market stays between 1410 and 1700 in this particular case, and this is on the Russell 2000 index, then you win. You get to keep the entire credit. Well, suppose that you expect this strategy to win most of the time, which you should, because it has an 82% probability of profit. It could look ugly when it loses, by the way, but that's another story for another day. But if you expect it to win 9 to 10 times a year, which if you do the math is about an 82% probability of profit, then there's not a whole lot to learn if the market stays between those two strikes and you don't touch the trade. If that happens, you make your 2,400 bucks. But what if instead on April 2nd, when the market was selling off, you panicked out of the trade when you were down 1,000 bucks? Okay? Well, then you would not have made the $2,400 roughly that you would have made by staying in the trade to expiration. And that's because you didn't follow your protocol. You didn't set it and forget it. You didn't forget about it, and you panicked and you closed the trade, even though your protocol was not to close the trade at all. Basically, let the probabilities play out. So, first of all, if you have a protocol, and I'm not suggesting this protocol, but if that was your protocol, you should follow it. If your back tests showed you that this protocol works, you should follow it. That's really the first takeaway from today's talk. But the second takeaway is, if you don't follow it, the least that you should do is to paper trade it as though you had followed it. This is a practice of some very solid options traders. They never stop keeping track of what would have happened had they follow their strategies. And what you're going to find in most cases is, if you let the trade play out as you had planned it, then your returns, actual returns, and your back tests would fairly closely approximate each other. It's when you get in and you muck around with your plan that you end up messing up the expectancies on these strategies. By paper trading it, continuing to paper trade the strategy even though you panicked out, it will teach you a very valuable lesson, and in some cases a painful lesson. Instead of losing $1,000 in this case, you would have made $2,400. That's a swing of $3,400. That's going to hurt your returns for the year when what should have been a really nice winning month turned into a lousy losing month. That's a big swing for your annual returns. That'll throw the returns of your back tests way off. So remember, every time you deviate from your strategy, you're now in a world that you've never validated. You're now in a world that you've never verified. And you will often find that if you have developed a solid strategy and back tested and gotten certain returns, if you can manage to emotionally stick with your plan, you're going to do a lot better than mucking around with it. You'll have a memory of the pain of that swing of $3,400 if you paper traded it afterwards. It's a form of trade review, really. If you don't do that, you won't really know, and you won't have a distinct memory of what you passed up by not following your plan. Sometimes the carrot is a reminder, sometimes the stick is a reminder. But the important thing to take away from today's video is that you need to have a process to prove to yourself that following your plan would have been a better outcome in most cases. Now, in some cases, it will not be a better outcome in any specific month. But over the long term, if you incorporate this practice into your trading business, you will find that you're going to be better off sticking with your plan the vast majority of the time.